Alright, now let's talk about money. Wall Street has been setting record highs left and right. The S&P 500 closed above 5,200 for the first time ever. The Nasdaq Composite topped 20,000 for the first time ever, and the Dow Jones is right behind it. So my question is simple: are we in a bull market? Is this rally sustainable? Or is this a big bubble ready to pop? Well, before we answer that, let me introduce myself. I'm the host. This is a show where we break down the biggest money, business, and success stories so you can start investing in yourself. And now let's get into it. Now, if you follow market news, you know there are two big forces driving stocks higher. First, people think the Fed will soon cut interest rates. Second, everyone's chasing AI, believing it will bring massive growth. So let's break those down. Now, rates are important because they affect how much businesses and people borrow. When the Fed raises rates, borrowing becomes more expensive, so growth slows down. People think of the Fed like a parent who says, "No, you can't have ice cream before dinner." That's because it wants to keep the economy healthy. Right now, inflation is still high, but it's slowing down, so the Fed might start cutting rates to stimulate growth by making borrowing cheaper. It's like saying, yes, you can have some ice cream after finishing your broccoli. In fact, Morgan Stanley predicts that the Fed will cut rates 4 times next year. That means the first rate cut could happen really soon, and that's got investors excited. Take a look at this chart. When the Fed cuts rates, the S&P 500 goes up on average 8%, and the Nasdaq jumps 12%. It's like magic, except it's economics. So lower rates should boost economic growth and corporate profits, which is good for stocks. That's factor no. 1. Factor no. 2 is AI. Think of AI as the new internet. Back in the 90s, no one understood the potential of the internet, but it was clear that things were changing. So investors put money into tech companies, pushing their stocks way up. Some say we're seeing something similar with AI. You probably heard of Chat, the AI chatbot that can write anything. It's free to use and it's growing fast. In less than 5 days, it amassed 1 million users. To put that in perspective, Instagram took 75, Facebook 25, even Twitter only took 3 days. And since AI is so hot, investors are pouring money into related stocks like Nvidia, Microsoft, and Oracle. Nvidia makes powerful computer chips that speed up AI. Microsoft integrated AI into its software, and Oracle jumped on the trend by offering AI tools through its cloud services. Basically, investors want a piece of the AI pie, and that's pushing stocks up. So on June 8th, the Nasdaq hit a record high thanks to AI, and a lot of experts agree this is just the beginning. Now, these 2 factors alone explain most of the rally. But let's talk about 3 more first. Global growth is looking better. After years of pandemic restrictions, China is growing faster. Europe and Japan are recovering, and the US economy is resilient. That's making investors optimistic about the future. Second, banks are lending again. After the banking crisis earlier this year, people were worried about lending, but now banks are lending again, which helps businesses grow and creates jobs. Third, companies are buying back their own stock. When a company buys back stock, it means it has extra cash and believes in its own future. Like in May, when Tesla announced a $1 billion stock buyback, it gave investors confidence in the company. All these factors are pushing the market up. But the question is, how long can it last? Well, here are a few risks. First, inflation could surprise us all. Remember, the goal of cutting rates is to boost growth. But if inflation suddenly goes back up, people's buying power will drop and companies' profits will shrink. That could affect stock prices. Second, not all stocks are benefiting. While AI-related stocks are soaring, other sectors are lagging behind. Healthcare, consumer staples, and energy aren't performing as well. Plus, the whole market is relying heavily on tech giants. They make up 30% of the Nasdaq. So if tech faces a setback, the entire market could suffer. Third, valuations are stretched. Stocks have been going up so much that some are overvalued. For example, Nvidia trades at a price-to-sales ratio of 217. That means you'd have to pay $217 for every $1 worth of sales. Usually, a high P ratio means a stock could fall if profits don't meet expectations. Fourth, history might not repeat itself. The market often goes up after rate cuts, but this time it's different because the economy faces unique challenges. Like the housing market is uncertain and the banking system is fragile. Finally, bubbles are real. When investors get super excited, they pour money into certain sectors, pushing up prices beyond what's reasonable. It happened with the dot-com bubble in the early 2000s, and some say it's happening with AI stocks today. That leaves us with one final risk. And that's me. Every time I say the B word, the market does the opposite. So maybe it's best not to listen to me. Okay, but seriously, these risks could impact the market. So it's essential to stay smart and not chase investments just because they're popular. Don't forget to consider diversification and risk management in your investment strategy. Do your research, invest wisely, and keep learning. So let me ask you, are you as excited about the market rally as I am? Drop a comment below and let me know. I love reading your thoughts. And if you want more insights on investing and financial trends, check out my videos. There's always something new coming. Thanks for watching, and until next time, remember, the best investment you can make is in yourself. Thanks for watching. Until next time, remember, the best investment you can make is in yourself.